attendees are in listen-only mode.
Good afternoon, everybody. Stan and Jack here for theartofchart.net, and we are doing a webinar today called Setups, Entries, and Exits. Learn how to make money in trading even when you're wrong. And I think the title, for me at least, says a lot, which is trading isn't about being right. Trading is about making money. And, you know, it's about probabilities. And it's about making sure that you manage your risk. Managing risk comes first, always, okay, in trading. So, you know, are you picky about your setups? Are you picky about how you manage your risk? Do you have systems for that? Well, if you don't, you're in the right place, because hopefully we can give you some background and education on how we do it. Now, what we do on theartofchart.net, let me go to my disclaimer here. Okay, the disclaimer that we give at the beginning of every webinar. What we do is for educational purposes only. We are not here to issue trading signals. We're here to basically teach you how to fish and not give you a fish. That's kind of how I think about it. So that's what the webinar is about for sure. Just a couple of other things, since some of you may be new to theartofchart.net. Let me just show you what's new, what we are now just beginning to crank up and get going. We have on theartofchart.net, first of all, a free webinar once a month on Sundays, okay? And the free webinar on Sundays, October 2nd, it's called Chart Chat. This is basically a review of all of these instruments above. So we review Forex, we review commodities, we review indexes, bonds, energies, and metals, and it takes an hour. We go through a lot of charts, but basically what it is a webinar for swing traders, so you can see what we see in the marketplace. So that's something that's once a month. Also, there's a 14-day free trial. If you want to find out what we're about, click on the 14-day free trial, and you can see all of the services that we offer for 14 days for free. And then at the end of that 14-day period, you can decide which ones you want, or maybe you want all of them, which is fine too. So it's really a choice sort of thing. Also, I would point your attention to our blog. And on our blog, we always have a post on free webinars. So we have a post coming up here tonight on the October free webinars for next month. You will find this recording on this page on our blog, September free webinars. The last webinar for September is this webinar on setups, entries, and exits. So, there's some other new things on theartofchart.net as well, and there's one new service, and I'll stop talking here in a minute. It's called the Big Five. Okay, so we have been, Jack and I, doing this for 2 years, and actually for the last year on this website. Actually a little bit longer than a year. It was last July that we actually started, Jack, if I remember right. And we're now offering stocks. Okay, we do 5 stocks. We consider these stocks the Big Five. Okay, Apple, Amazon, Netflix, Facebook, and Tesla. And we do a video on the weekend, and we do 2 chart updates, one on Sunday, one on Tuesday and Wednesday. And so this is intended for those of you who like to trade stocks, and our methodologies work on these 5 stocks extremely well. And so this is another free trial. This is another 14-day free trial if anybody wants to try it out. And that's really what's new on theartofchart.net are those things. And that said, Jack, I think we're probably ready to start the webinar in terms of the outline. The outline for the webinar, basically, we're going to talk about setups, entries, and exits, having a 2-sided plan, and using a system. Okay, and so we're going to talk about risk management, position sizing, volatility, managing risk, managing size, legging in and out of trades. I'm going to show you a drawdown histogram, which is something I use in trading. I'll show you something else in terms of managing size, in terms of managing stops as well. 2% rule, 20% rule, and something called maximum drawdown that I will talk about. So Jack and I are going to do this together. And Jack, why don't you start with the entry piece? And let me throw you the screen, and you have it.
All right. Right, you seeing it okay?
Yeah.
I'm
Great.
not actually starting, but it's going to be one I'm coming to later. I'm going to use a mixture of old and new charts today. So we've got, hang on 1 second, let's just see when my picture viewer's got to. Right, Now, I just want to talk about a variety of different ways in which you can find decent entry and exit levels, and there are a lot of these. And I want to talk about an example I was using this morning, which was on ZB. Now here, this is the chart I posted this morning, and what we had done was we had a rising wedge from this low, and we're expecting a big high here because on the pattern structure, actually I'll just show you the TNX chart on that. This is a chart I prepared earlier. In fact, I prepared it a month ago. And a month ago, what I did was I was looking at this structure here because this is the pattern structure, and there was a strongly implied likely sequence, a higher probability path, I would call it, that came from this pattern setup. Because that's a nice triangle. You've got your A, B, C, D, E, etc. So what I did was we were here at this 1635 high, and I drew it and made these notes here. And what I said was that what we would normally expect is you've got the breakup from the triangle here. That's the E wave, which is the last wave. You've got the breakup. So I said you would normally get a break back into the triangle. I drew that arrow. Now, I did say when I was doing it that I wasn't really taking much account of time. So it wasn't intended to be accurate in time. It was intended to be accurate in price. But you can see, haven't with any of these arrows. We come down there, complex correction back to 1519. That's a very significant level, actually, by the way. That's 1518 over there. 1519 here. Now, the next move was going to be a move up here, and I was treating this as A, B, C. So that was an A equals C target, and this is also an inverted head and shoulders, potentially. So what I was thinking was we'd go up to this very strong target at 1750, and then it would probably reverse back down. Now that would have an ideal, the left shoulder low was at 1518, so you'd be looking, really, you're looking for a short here. Well, first off, you're looking for a long here, then you're looking for a short here, then you're looking for a long here, and these are all, if you can get in at the right level, it's fairly tight, i.e. your potential reward is considerably larger than your actual risk. You could have gone in at 1750 dead here, and it only ever went 2 ticks against you. And this is the TNX chart, but I was using this to call price on ZB and TLT. Now, at this stage, which is where we are now,
I think you're making a very important point. So, and the point he's making, it's about these levels, but it's at an extreme, and that's the hard part about trading, because you're at an extreme. You're like, holy cow, we're at 1750, and it's very bullish. Well, guess what? You got to have the moxie to put the trade on and use a reasonable stop, etc. But that's where your best trades are. It's at an extreme, and it's hard to do. It's hard to do. That's what I want to say.
The message of this chart is it is actually possible to predict one of the higher probability paths, and it can always go another way. But nonetheless, it's gone this. And what was going to happen here? Well, at this stage, this was going to be the key long entry on TNX and short entry on ZB in the process, because at this stage you have formed your right shoulder on your inverted head shoulders, and you would be heading off. So on we did a tie on ZB yesterday, which was at hang on, let's have a quick look. Right, that was at 170. Very nice call, Stan. He called 170, reckoned it would go very little above it, and I was thinking it might go as high as 170, 15 to 30. But you know what? It just got to 170, stalled within 3 ticks or something, and then was on the way down, and that was our high. But at that stage, you're running the Fibonacci's and you're looking at the key support levels. This is a potential head and shoulder neckline mark there. These are the Fibonacci levels, 38, 50, 61.8. I'll be talking more about those because these are really important for identifying levels. You're looking around for divergences. This wasn't particularly helpful because actually we had a divergence that fixed here into a sell signal on my system. And it continued up on maintained negative divergence all this way up. You will often see that in a strong trend, and you need to be aware of it. But we get to the level, we reverse there, we're at in the right area on the TNX chart, and we have a rising wedge from the low. Now, really, this is just 2 sets of trend lines together. All patterns composed of trend lines, pretty much. And here you've just basically got a compressing channel. I.e. it is getting narrower as it goes on. A megaphone's expanding channel, and a straight channel is it's just parallel lines. They're all variants on the same thing. But this is what contains the trend. This is a mature trend. It's reached the likely target, and then it breaks. So I posted this last night, and it had just broken this, and this is this morning's version where it's had night retrace, and we're getting down here. What is this looking like? Well, this is looking like a contracting channel. So a falling wedge. These tend to break down. The rising wedges, the falling wedges tend to break up. So I was warning in the video this morning, some of you will have seen it, that we're still looking for a reversal pattern here, and that reversal pattern might well involve a retest of the high. And we have almost retested the high today. We've come back up onto 169, what was it, Stan, 25?
Yes, it was.
We've come back within a few ticks of the high, and that is doing two things, because another thing you're looking for at levels is retests of broken trend lines. You will often get, because the thing is, if you can get the right level, then you can improve your chances. If you can improve your entry, then you can improve your chances of staying in the trade and making good money on the trade. Mm-hmm. It's not enough to just say, I think it's going to go up, and just pile in, because you've got no clear structure, you've got no clear risk reward. The fact is, it's just all fuzzy. You're just basically going in and hoping for the best. You can use math to really, really improve your entries. And this is trend lines, Fibonacci's. This is a retest because after you get a pattern like this break, then you're generally looking for a topping pattern. Something like 2/3 of those are going to be retests. No one ever seems to expect the retests, but they happen
all the time. Absolutely.
So, this morning everyone was thinking, ZB, it's time to crack open the champagne, etc. And I warned them that we may well go back and retest it. I think it's going to fail there. Won't always, but I think pretty sure this one's going to. And then that is the end of the move. And that actually is the ideal short entry at this high, which I'm thinking we'll probably see overnight or tomorrow.
What was our level on ZB, Jack, on the way up at 168? Was it 12 or was it 08 or something like that? I'm trying to remember. We were looking for resistance, and if you look to the left there, it was 168.12, I thought, and we had resistance.
It was 168.07. And it held it to the tick.
So when you see on the way up prices being held in by a level, well, guess what? On the way down, that could be support. So until we break 07s, there's no confirmation to the downside on this instrument. So that's one aspect of trading and managing risk is how do you confirm the move that you think is going to make? Do you use a confirmation level? And so the best confirmation levels are previous resistance on the way up, in this case, for example, or vice versa.
I've got another very good example on ES today. All right, I was talking about, well, this morning again, I was talking about the possibility of a retracement, the likelihood of seeing some retracement today. And I pointed out two support trend lines that I was looking at, and here is the first one, which is the possible rising wedge one. It's very important how you draw your trend lines. We've actually got a whole separate webinar on trend lines, but on how to draw trend lines. But this one, very nice trend line, and that's supported by the weekly pivot, which is a very important level. And you can see it's a very important level because look at this week, failed there, down, failed there, broke over it, back below it, and then and we broke back below it today because I was looking for support there on this trend line. Nope, didn't see it. Then I had this trend line, which was a 2147, went straight through that. Where did it land up? Here, it hit this trend line, the main rising support from the low, which I had marked in. It hit it exactly and reversed there. That is the power of trend lines. Very much so. You see that happen a lot. The thing is, if you can pick out the key levels, and then of course I tweeted this chart, the updated version of this chart, and I said the key level for the rest of the day is this level here, which is the weekly pivot at 2152.25, and we went up there, and it was either obviously going to succeed or fail, and it failed. But the thing is, you've got a long entry above it. On a back test, on a break above it. It'll often back test the level, and you've got a nice little long entry with that as support below. And then on the way when it's coming up to test it, retest it, as I think sure a lot of people did today, you short against that weekly pivot, and if it fails, then you get a very nice high risk reward trade. That is the importance of levels. And actually, I'll just mention one last thing on levels as well. You often get people talking about trading with the trend. What's the advantage of trading with the trend if you get your entries right? Well, I'll tell you. Here, we came down. This was at 2138 when we hit it. And really, from, certainly the people, on our Twitter feed and so on, you could easily have got it at 2139. We called it. I think I posted this chart when it was at 2139. So the fact is, you can get in there, and you've got a two-handle stop. And I think on the version I posted, I put in what will be the resistance trend line here, and it's 35 handles higher. That's brilliant. Furthermore, if it holds on the first test, by tomorrow, your entry is under the trend line. And that's a big advantage of trading with the trend. The trend lines are your friends. When you're trading with the trends, they are not your friends when you're trading against it. Because when you're trading with it, if you're buying a support trend line, then it's only going to hold for a day, and then your even stop leads you in profit. You have a risk-free trade at that stage. If you're shorting against a resistance trend line, you can do exactly the same thing. Counter trend, you cannot rely on that, but trading with the trends, you can. So you can get some of your very nicest entries. That's trend lines like that, which is why I was pointing out levels this morning. All right.
Very good.
Great. Well, shall I talk about fibs? I just want to show a few very nice fib examples.
Okay.
Okay. Well, I'll just say, one thing I just want to get across with all of this is that these pattern structures, and I'll show you some prettier ones where it's clearer. There's an awful lot of information on this chart, and most people reading the chart will only be, I try to highlight the more important parts, like this is the main score, so it's thicker, etc. But all of these work on multiple time frames. You can see, if this is on an hourly chart, you can see this on a weekly chart. You can see this on a 1 minute chart. You will find, apart from the fact that on the monthly charts you have to start taking account of the fact that you have inflation and the value of money is deteriorating, so then, which is a gradual process but a steady one, then apart from that, really the pattern setups are pretty much the same. The double tops are the same, the inverted head and shoulders are the same, the triangles are the same. And also the Fibonacci's are the same. I'll just show you. This is a very, very famous retracement. This is the 87 crash, and this is the uptrend that led to the 87 crash. Now, it's still people talking about it. There was panic, blood on the streets. No one knew what was going to happen. What happened here? We had an uptrend here from a low in 1982. You had a pattern broke up, another pattern that then broke down. There was a nasty breakdown because it actually gapped through it and went a long way below it. On the plus side, anyone waiting to buy this trend line, it was never reached. So, so chances are they escaped. But the thing is, look at what happened here. Where did it retrace to?
There's an important lesson there too. For those of you who buy at the end of a trend day, I want you to look at that bar right there before the gap. Okay, so if you bought at the end of the day just blindly without looking at trend lines and possibilities and looking at Fibonacci's, well, just buying blindly at the end of the day right there would have cost you a whole lot of money.
And actually, if you bought at the end of the previous candle, that again would have not ended too well.
That's right.
So, because that was a thick red one, then that mean it was going to bounce next week? It did not. It really didn't. So the thing is, what's the upshot of all this? It's uncontrolled, blood in the streets. It's the end of days. What you're looking at here is a 50% retracement of this bull market. That's it, and it's a fairly exact 50% retracement. When you strip out all the excitement and put the trend lines down and analyze it properly, then that's all it was. Furthermore, you went and hit a support trend line, the main support trend line from this low. At the low there. So it happened, sure, it happened really fast. Was it chaotic? Did it mathematically make no sense? Not at all. Mathematically it made perfect sense. And this is not chaotic. It's fast, but it's not chaotic. The 50%, the 61.8, 38.2, these really work. Particularly on big retracements, the 15, 61.8 are very key support levels. If you ever see, and you saw this again in the bear market in 2011, if you on my chart, which I won't show you today, the 2008-9 crash was actually the entire move from the high there to the low, and was basically a correction of the previous the bull markets, the major bull market of the last 20 years, and again it was almost exactly 61.8%. If you see this sort of thing where you see a spike down to a major fib, big rally, spike down again, there is a very good chance you're looking at a marginal lower low that will then be a major low.
Yes, absolutely.
Saw that there.
That's a pattern right there that you see over and over again. everywhere on
God.
multiple time frames.
Yeah, you saw it. You see it intraday a lot. You see it on the charts like this. You see it on the monthly. But I mean, this is if you have a look at the bear market in 2011, exactly the same thing. Comes down, big fib level, big rally, comes down, marginal new low, and then goes, and that's for life. These things really, really, really deliver. Learn how to draw these things, otherwise you're flying half blind.
Yep.
But in terms of if you were shorting, you could have easily, I mean, when you're getting to this trend line, easy to identify this as a megaphone. It overthrew here, which told you the megaphone was going to break down. Didn't tell you how fast it was going to break down. But I mean, you could have easily got short in this area here. There would have been shorter-term signals too. You've got negative divergence on the RSI. You know, you've got everything except a big sign saying short me here. So very easy to get in short there. Pretty easy to get in short there. So very easy to see that this is a likely target area and get out close to it and to go long again on this retest here. That is the power of good entries. It's because it can give you a trade you can easily stay in, which won't give you a lot of heat. All right? Great. What would you like to talk about, Stan?
I have some risk management stuff to talk about.
Okay. Actually, I just want to show one more trend line example. This is one of my favorites. Okay, February 2011. I called an inflection point on, this is TYX, which is the 30-year Treasury yields. Yeah, and what I did was I had a theoretical but very likely channel here. I had the channel support trend line, I had a theoretical channel resistance trend line, which wasn't quite perfect. I was predicting a hit of this trend line, and at that point it would either break up or reverse back down. And it hit this, and then yields halved over the next year. Just saying. Being able to draw trend lines and be aware of the major chart patterns and so on can give you opportunities like that, where you can get wildly good entries and exits. Right, great. I'll throw it back to you, Stan.
Okay, great, Jack. Thank you. Okay, so Jack is talking about one very important trading skill, which is the entry part, and what to look for on entries. And by the way, that's the trading skill that I would talk about, being good with patterns, being good with charts, being good with Fibonacci's. Now, there are two other skill sets to being a trader. One is managing your risk, okay, in terms of being a trader and knowing how to trade, okay, and the other skill set is managing your head, okay, and I believe that they're both very tightly correlated. Let me show you what I'm talking about. Here's a chart on oil. This is the latest stuff on oil that we've been working with, and I'm going to show you a setup, but I'm going to show you how to manage the risk in the setup as a trader, okay? So the first thing I look at is, where is the setup in here? And very recently what we said, and we were wrong. I was wrong about this. I'm intentionally going over a trade where I was wrong. I said, hey guys, look, 3 down into the X wave here, okay? We have a triangle in A, B, C, D, E. Wow, this is a great setup. I even said that on the recording. Great setup, and by the way, I was wrong, okay? Now, how did I trade this? And I was long here, okay? And it was an incorrect trade, but I still made money. And the title of this video is, how do you make money even when you're wrong? Okay, so I'm going to show you the incorrect analysis, but I even made money with incorrect analysis. So the first step I do in managing a trade, okay, I go to the daily chart and I look at average true range. Now, average true range, and I use a 7-day average of average true range on oil. And all of my charts, I use a different average true range, okay? So roughly speaking, I'm just going to say that at that point in time on that bar, let me just try to find that bar. I'm just going to say that we were at $1.80, okay? $1.80 is the average true range for oil, 7-day average. Now, what I do is I take a third of that. Okay, a third of that is 60 ticks. Okay, so what I'm doing is I'm taking a 1/3 ATR, a 1/3 ATR, and what a 1/3 ATR does is it tells me how much risk I have to, what kind of risk I have to put into a trade. Okay, so I have to put 60 ticks of risk into a trade. Then I go to my chart, knowing that I have 60 ticks of risk, okay? And I look at this level right here, and I say to myself, okay, 3 down into the X, boy, that looks like a good setup. 60 ticks below that, where does that leave me? Okay, so I look at the low, and it's 44.60, okay? 60 ticks below is 44. And I say, close to the trend line, do I want to take this trade? We're not at a trend line, but I shouldn't be at a trend line because this is a triangle, an A, B, C, D, E. We have compression on RSI. Look here at the setup, okay? We're below 30 on RSI, so RSI is lining up, okay? This is lining up from a formation perspective, and so I take the trade, right? And I use a 60-tick stop, okay? Now, what happened? Well, I'm gonna zoom in here so everybody can see this a little more clearly. I'm going to go down to a 15-minute chart. And again, folks, it doesn't matter what chart you use, whether it's a 1-minute chart or an hourly chart. All these techniques work. Okay, so here I am. I'm long at 44.30. Okay, and whoosh, we get this with this move. Now, what do I do to manage the trade? Okay, first of all, I am looking at Fibonacci's, and I look at the previous swing right here. Okay, and this is using fibs to manage your trade. 50% back is just above the blue line. The blue line is the monthly pivot. Okay, we cross the monthly pivot at 45.34, and I take off a third of my trade. So I'm off a third right there, and my stop is even. I can lose no money. Okay, so right there, I've made a buck in oil. I made 100 ticks. Okay, which is $1,000 per lot. And my stop's at even. I have nothing to lose. What do? I leave it on, okay? Now, what happened? Well, take a look. Let's just take a look. I'm going to just delete this so it's not in my way. But I'm trying to walk you through the anatomy of managing a trade, managing risk. So I look at the chart setup. I determine how much risk I'm willing to make based on volatility, okay? Now, I encourage you guys to use average true range because it's a true measure of volatility versus just having a haphazard, oh, I'm only going to risk 2 handles or 20 ticks or whatever, okay? Because depending upon the volatility level, your stop level has to move with it, if you will. So here we are, and what happened? I got stopped out, okay? Now, what I said the next evening was, this is a double bottom, okay? My analysis the evening before was wrong. Even though it was wrong, I made money, okay? And now what this is a larger 3-back, and I said, this is a good setup. And whoosh, it happened again. So, for me, if I'm wrong and I'm off a third, I don't care if I'm wrong. Let me be wrong. Guess what? I get another bite at the apple. Okay, so this is a great example of that. And look at the swing, and I do the same thing. And trade like a machine is what I encourage everybody to do. Okay, use your systems. Okay, what's the 50% back level? 55.33, I'm off a third. 3 up, and these are basically the rules for managing your trade in a swing. Okay, and by the way, I do the same thing when I'm day trading. Okay, so if I have a previous swing, 50% back, I'm off a third, my stop's at even. 3 up into the 100% fib, I'm off 2/3. I'm off 2/3 this trade right now, okay? So let me come back to the 60-minute chart because I have a choice to make here now in managing this trade, okay? So I know my stop level is 60 ticks. But by the way, because volatility, I could trail 60 ticks behind me if I wanted to, but I don't do that, okay? Right now, I would leave my stop at the monthly pivot. I haven't moved my stop yet. It's still at even, okay? And I can't tell you how many times I have been stopped out of a trade where I have a third on and it comes all the way back. And if it does, it doesn't bother me because I believe that trading is about incremental wins, okay? I'm not looking to hit a home run. I'm looking to get a third here, 2/3 here, maybe the whole position, okay? I'm looking to add back to a trade when I can, okay? But the thing you don't want to do is just get out of your trade too early, okay? You don't want to do that. And you also want to size your trade so that you can get out in thirds at least, okay? So, if you're trading oil, in my opinion, you should have a $100,000 account and you should be putting on at least 3 legs, okay, at least 10% of your entire account portfolio. I would never ever encourage anybody listening to me to ever put on more than 20% of your account size unless you really, really know what you're doing. Okay, if you do, I know folks that go 40, 50, that's fine. But if you're inexperienced, I'd never put more than 20% on a trade. I think especially in futures, because they're highly leveraged instruments and you can lose a lot of money very quickly. So so where are we with this trade right now? I have a third on. I'm waiting for the back test and higher. We said we would hit a 48 last night. We did. I'm looking for a back test to add back. Okay, where do you think that back test is going to come to? Well, where is previous resistance? Right here at the D wave, okay? Look over here. This is called a floor ceiling. Now again, I'm integrating, if you will, knowledge of trading in terms of technical analysis with knowledge of how to trade. Okay, so I got a third on, I'm holding it, I'm waiting for the back test. I see support here, guys. I'm putting it back on for the next leg up. Okay, that hasn't happened yet. And again, using fibs, as Jack mentioned, okay, look at the 50 back area. 50 back is right smack dab in the middle of that yellow box at 46.31. Okay, so 46.31 is the area I'm looking for. It may not get all the way there. I may incrementally add back, okay, but I believe we have a high window, and my analysis says we're going to go higher. I'm looking for a back test. I have 2/3 off now. I've made money, okay. I'm looking for the add back where I can then ride the next wave up. Now, what am I doing here? Just want to be clear about this. I'm first of all looking for volatility, right? The volatility level that I mentioned, which is average true range. Secondly, I have a bigger picture perspective on oil. Okay, so on a bigger picture perspective, I believe this is an X wave. We have a WXY coming. We have an uptrend coming. I'm banking on the trend, as Jack said. Okay. And I'm using Fibonacci's, and I'm using structure, and I'm using my knowledge of trading to use stops and to take profit as I go. Okay, so 2/3 off. I'm looking for a back test. I'm going to add back, and I'm going to ride it back up. Okay, and by the way, on the trend back up, I'm going to do the same thing. I'm going to take off a third, take off a second third, and guess what? The last third I'm going to be greedy with, and I'm going to let it ride. So I'm sorry, Jack, go ahead.
Yeah, another thing, just looking at Stan's chart here, to mention is another advantage of trading with the trend is a trend like this is like 2 steps forward or 3 steps forward and 1 step back. The 1 step back is not nearly as interesting as the 3 steps forward. You can make far more money on the 3 steps forward. Furthermore, if you then get caught by, as long as you have the trend right, and obviously there's various methods of determining whether you do have the trend right and you measure risk and so on and so forth, but you know, if you have your overall trend right, you will get bailed out if you're with the trend, if you hang on to it. If you're against the trend, then chances are you won't.
Yep. There's one other thing to add to that in terms of the trend. Okay, so and by the way, I purposely chose this example because you can be wrong and still make money. It's not about being right. It's about knowing how to trade and manage your trade so you make money even when you're wrong. Now, I mentioned 60 ticks here. Okay, let me just cover something which is important. Okay, what if the volatility level is so high that the volatility level on oil, let's just say it's $2, okay, and you have a $50,000 account? Should you be trading oil? And my answer is no. Okay, you have to know when not to trade, and knowing when not to trade is when volatility is so high that a loss is greater. Like, for example, in this case, if 60 ticks in oil with my position size, if I had 10 contracts on, for example, right? And if I lost 60 ticks, okay, that would be roughly speaking $6,000. Well, you know, if I have a $50,000 account and I'm going to lose $6,000 on a trade, guess what? I'm not going to take the trade because I don't want to lose more than 2 or 3% in a loss. Okay, so that's the 2% rule, is you look at volatility, you look at your stop, and you say, okay, what's my position size? Okay, here's my position size. Now, what if I lose 60 ticks? Am I over my 2 or 3% limit? And if I am, you need to reduce your position size. And the reason I do that, and the reason I mention that, and trading isn't about taking risk, it's about managing risk, okay? And why do that? I want to sleep at night, guys. I want to sleep comfortably at night and not worry, okay? Am I going to lose sleep over a 2 or 3% loss? No, I'm not. And oh, by the way, just to make the point, even if I took this trade here and I didn't get stopped out, because I moved my stop to even. What if I left my stop at 60 ticks, which was at 44s, okay? I never got stopped out in the first place if I left my stop there. So, you know, these stop levels I'm talking about, using 1/3 of an ATR, okay, 1/3 of an average true range 7-day ATR is magic on oil. Okay, I've been using it for a lot of years. So anyway, so those are my comments, Jack, on the 2% rule, the 20% rule, which I think are important, and also legging in and out of trades and using structure and Fibonacci's to help you do that. Anything else you want to cover, Jack? Oh, I'm sorry. There's one other thing I wanted to cover very briefly. Okay, I want to talk about a histogram of drawdowns. Now, if you're a trader and you've traded for years, you know what a maximum drawdown is. Okay, so you have a system that you trade, And if you've back tested your system, you know that, like for example, the system I trade here with oil, the maximum drawdown on it is $1.38. That's my maximum drawdown. I know what the maximum drawdown is over the last 5 years. Okay. Secondly, I also know what my histogram of drawdowns are. Okay. So here with the system that I'm currently trading on oil, I know that I have 45 trades at $200 in terms of my drawdowns. Okay. I have 35 trades at $400. And the point of this is the following. 88% of the time, I am under $1,000 in loss. Okay. So, you know, if I really want to make a trade in oil and I feel really confident about it, I set my stop to $1 in this system. And why do I do that? Because I know 88% of the time my trade is not going to get stopped out. Okay, because I know my histogram here shows me what my history is of drawdowns. So to you guys as traders, do you trade systematically? Number one is a question. Number two, do you have a record of your drawdowns by instrument? Okay, and you go back over your account statements and you look at your drawdowns and you look at how big they are. They should look like this, meaning the larger drawdowns are smaller, the shorter drawdowns or the smaller drawdowns are more frequent, right? And then you find a level where it's like, hey, 75, like probably $800 is probably 75% of the time or something like that. You know, if I'm making a trade and I know that 75% of the time I'm not going to, my drawdown won't get that big, more than $800. That gives me a mental advantage. Okay, that's the mental advantage to trading. Okay, to know going in that if I trade according to the system, my drawdown won't be more than $800. Okay, I put trades on and I sleep really well at night as a result. Okay, so I think that's the thing about trading. Everybody, is I'm trying to introduce a more advanced concept here, which is a drawdown record, right? But the idea of it is to manage your head. Okay, I manage my head really, really well, and I'm very calm when I trade because I have this knowledge about the system I'm using and how much drawdown I can expect. If I see, you know, if I see a you know 75 tick drawdown in oil, I don't get excited. Okay, when I see something over anywhere near $1, then I'm like, okay, this is one of those exceptions. This is the 15% rule or whatever, and I get out. So I think a histogram of drawdowns for anybody who trades is essential, okay? And I encourage everybody listening to me, put together a system that works for you, whatever that is, and track your drawdown history. Okay, sorry, Jack, I wanted to explain that. I thought it was an important point. So you have something else?
Yes, I just wanted to talk about Fibonacci's and retracements and so on in a trend.
Okay.
And how you could use.
And everybody listening, I'd encourage you while Jack's talking, we have no questions. Any questions you have, please ask. And we're going to get the questions when Jack wraps this piece up, I think.
Okay, now this is a very, very good example of basically entries, exits, and Fibonacci's, and reversal patterns. Now, basically, you've got three types of trading. You've got one real type of trending pattern. You've got a channel. Those divide into three kinds. You've got the expanding channel, which is a megaphone, and this is one of those. You've got the channel with parallel lines. Actually, you don't have any of those on this chart, but everyone's familiar with those anyway. And you have wedges, which are basically contraction channels. And you've got one there, you've got one there, and you've got one here and one here. Now, I was watching this for years because right through this 2008-9 crash, I was incredulous that on a flight safety people were going to the yen, which was, I mean, the whole country is bankrupt. They're awash in a vast sea of debt, and it was just slightly comical that they was going to the yen. But it wasn't a strong uptrend. It was definitely, and people were going to it when things were getting rough, and so you've got to respect that. But obviously you have to be alert for when it's going to turn. Now, nice rising wedge formed here. This is a clear head and shoulders forming, and you have a slight overthrow there. So you've overthrown that slightly. You've then come down. You've broken support. You're then looking for a pattern, and you had an ideal entry. Normally on the head and shoulders, even if the neckline is even if the neckline is sloping, you're really looking, or ideally, and you see it a lot, for the shoulder highs to be in the same sort of area. You got that, and then it broke the trend line for the second time, and I called it short here. And that was a very, very nice short entry. Very nice. Now, obviously, it then drops like a rock, and we fast forward a couple of years, 3 years, and then there's a video clip I posted of me talking about this in August 2015. Now, what's it done then? Well, it's trended down in a very clear pattern again. It's a very nice falling wedge. We're still in the wedge at that point. But at that stage, it's made the full wedge target, which is a retracement of this here. We're getting positive divergence on RSI, and I'm thinking seriously about a low. And also, we are contracting to the point in the wedge that it's clearly not going to be sustained for much longer because then we're running out of wedge. It can only contract so far before the trend lines meet. So I'm looking for a low here, and I was looking for targets. What are the obvious targets here? Well, you've got the retest of this broken major support trend line here. And the other one I was talking about, really on this, if you're talking about a continuation wedge, so you're basically talking about within a downtrend, you'll get your 3 steps down, you'll get your 1 step up, and you'll get your next 3 steps down. Now, the end, frankly, well, who knows where that could end up going, but you can see it's been an awful lot lower than it is now on this chart. So this wedge, could it retrace all the way back to 40 here? Yeah, I think it could, and I think it might. And so I was talking about the long here, the break, the possible inverted head and shoulders be forming, and all played out. And I was talking about the 2 main targets being the retest of this trend line here and the 38.2% Fib. Look at that. Yeah. And now we're getting some negative divergence, and I think we're looking for a high here, and it's going to turn here, and then it should at least retest this low, and chances are it's going to go lower. So here you've got ideal short entry. Where are you looking for exits? You're taking some money at the Fibonacci retracements of this wedge here. You're leaving a runner on, and you're probably taking that runner off when the wedge breaks up here, and switching over to longs. It's and here you've probably taken off the majority of the money at the at these 2 targets here, and at the moment you're seriously considering switching short for another big trade for a move down. And this is the importance of trend lines, Fibonacci's, patterns, etc., and picking where you go in and where you go out. Your lowest risk points are when you're breaking trend lines, you've already identified the likely reversal pattern, you're making a lower high. I mean, this is, you can pick your entries, because by the time you get down to here, you're very, very vulnerable to big rallies, big reversals. You are, if you short in the hole, or you go long at a, when everyone's incredibly complacent and just assuming that everything's going to go up forever, then you are highly exposed. Your downside your downside prospects might be very good, but your exposure to a rally which could really, really, really make you sleep badly is extremely high. You can pick your entries very, very well. You can pick your entry level, your exit levels well too. But I was talking about this, it's pretty much played out exactly as I was talking last August. That happens regularly because all of these things are mathematical structures.
Yep.
And you can use that to your advantage. And these things aren't rocket science. Fibonacci levels aren't rocket science. You'll get these standard tools on more or less every single charting package.
And let's talk something just for a moment about Fibonacci's. Why do you think they work? Do you think they work because flowers can be depicted in Fibonacci levels and they're natural and all that other stuff? No, I think all eyes are on the 50% retracement level on a back test. There are a lot of computer programs that look at it. There are lots of eyes that look at it. So these fibs that Jack is talking about, there are lots of eyes on these guys, and that's why you use them.
Because you can get into the philosophy of it and why it should work, etc. But to a certain extent, technical analysis should be the ultimate practical discipline. If it doesn't work, discard it. And actually, it doesn't really matter why it works as long as it does.
I think that's right. And the other thing is, look at the systems that folks traded years ago, right? They don't work anymore. And why? Because eyes have moved to other ways of trading. So you got to figure out what the eyes are doing, in my opinion.
Yep. Ready? Find out what works now. And trial and error is very important. Use your eyes.
I agree. Okay. Questions? You ready, Jack?
Yep.
Okay. What ATR do you use for the E-mini, and how many days ATR? And by the way, my ATRs are simple, always, and I use 1/3, and what I do, Geraldo, is I vary the length of time. It's either a 3-day, 5-day, or 7-day ATR. For example, with something really volatile like RBOB or heating oil, okay? I'm using a 3-day. Okay, for something that's a little bit more relaxed like oil, and by the way, I feel very, very comfortable trading oil. It's one of my main instruments. Okay, I'm a commodity trader, and you know, I use a 7 on oil. Now for the mini, I use a 5. Okay, and I think you have to. And by the way, I think the mini right now is the ATR, if I'm not mistaken, is a 21. So you use a 1/3 ATR, and if I'm doing a swing trade on the mini, I'm using a 7-handle stop. Now, if I'm day trading the mini, I'm using a shorter stop, okay? If I'm looking at like making 2 or 3 trades in a day, trying to catch a day trend or something like that, which I very often do that against a position. So I normally have a core position on and I'm trading against it. So I'm trading in 2 accounts, okay? So, you know, if you trade in 2 accounts, that's great. You can day trade. But when I talk about ATR here, I'm talking about I'm looking to put on a position that I'm going to hold for at least 2 or 3 days, maybe leg in, leg out. You know, it could be, the trade could happen over a 2-week period. And so in the mini, I think the ATR right now is a 21, if I'm not mistaken. I'm using a 5-day, and I'm using a 7-handle stop for swings, okay? There's a lot of talk about, Jack, do you have anything to add on the ATR question?
Nope.
Okay. There's one here on systems, Jack. I think this one's for you. I can add something to it as well. There's a lot of talk about creating a system that fits you, and I think that's important. Your charts are quite full, not easy for others to get off the bat. Please describe, 1, what systems you use, and 2, how these have developed.
Well, it depends what you class as a system. I mean, if you're looking at this chart here and how it traded, I was describing the system. You've got your trends, you've got your reversals, you've got your Fibonacci's for levels. You've got, I mean, there are. It's important to be able to draw trend lines correctly. We have a webinar where we just talk about drawing trend lines correctly. It's important to get your psychology right. It's important to try and avoid chasing when you can. Because piling into something when everyone else has already got into it and everyone knows it's going to work is often the point at which it's going to reverse, no matter how convincing it sounds. So what you need to do is find out where the relatively low risk, high risk reward areas are to go long and short within trends. Be patient. Wait for your setup. Now on a setup like this, I was waiting 3 years. I was watching this. Now, normally you're not waiting that long, sure, but the thing is, you're looking at exactly the same setups intraday. You know, we call intraday stuff quite a lot. So you know, the divergences, the intraday. I mainly use the 1 minute and the 5 minutes. I'm not using the monthly charts then. But for a really nice long-term swing trade, you know, you can take these off the monthly chart, but you got to wait. You wait for your opportunity and you take it. And when I did a post just after this trend line break for the second time, and I called the end short and on my blog, and I didn't actually really follow the end much, but I'd mentioned a couple of times there might be a big trade coming, and off it goes. It's and again, I was talking about it as we were getting to the low here, because these are just, you know, you need to wait for a while for them. But the thing is, actually, for every setup, you have to wait for the setup. You have to wait for the levels. If you're going to get good entries, just take what is in front of you. You've got to plan it. And you've got to wait. You've got to wait patiently. One of the hardest things to do as a trader is to wait. Yep. You've got to be able to you've got to let the setup come to you. You can use your skills to identify where the right levels are, and then you've got to have the self-discipline to wait for the setup to be ready, so that you can get in at the right level and maximize your chances of success.
Yep. Let me add to that, Jack. What systems do you use, and how these systems have developed? A system, first of all, is defined by, I have a technique or tool or combinations of tools. When I use them together, I have a 70% chance of being right. So first of all, a system doesn't exist until you have a percentage, a probability. okay? So for example, let's just talk about Jack's system here. The system Jack uses, you see the rising wedge right there? That goes up to the main trend line up at 132.18. That's a rising wedge. That has a 70% chance of breaking down, okay? Yep. So he waits. By the way, if you use Fibonacci's, there's a 3 up there to 100% fib right up at the same area, okay? So you could take the rising wedge, integrate it with a 3 up 100% fib, which goes to the same area. And then up above, look at the RSI 5 sell signal, okay? So you have 3 observations: divergence on an RSI 5, a rising wedge with a 100% Fibonacci, okay? That's a system. Now, what you have to do is you have to track that. And you say to yourself, when I see that system show up, that's a 70% chance of a win. And then what you do is you define the system. Now, Jack, could you throw back the chart? Because I want to just, we never had a question on systems before. I want to show what defining a system is.
I think Stan's absolutely right. Hang on, just make one quick observation on that.
Yep.
Here, your elements of an overall system for identifying these, you've got the Fibonacci's, you've got the patterns, this is the trending pattern, this is the reversal pattern. You've got the RSI here. I mean, here you've got basically increasing negative divergence and a very powerful trend up. But then you're finding you're getting a decent trend line. It's overthrowing there. That could be breaking up, but the chances are it's a bearish overthrow, and it's signaling that it's about to break down. This is a multiple. It's not just one system, but I mean, the fact is, if you could program it so that a computer could do it, the fact is, a computer would already be doing it. Because they're programmed for a lot more complex things than that. I think it's very difficult for a computer to duplicate this, just because there's a lot of judgment and experience in doing it. But the fact is, this is a very clear mathematical structure, and you're starting off with a 70% chance that this breaks down. With all these other things, with the RSI and these other things, you are improving on that percentage. And you're also giving yourself a good idea of where it's going to go next. All right, great. I'll throw it back to you, Sam.
Okay, great. Let me show you how I define a system, Tom. This is important because, I am a systems trader and I use systems a lot, okay? And I think it's important for you to have a way of defining it. I'm trying to find something here, Jack. Hold on a second. Give me a moment to... And Tom, I'm re-recording this segment because somehow my screen didn't show, but whatever. Anyway, this is how I define a system, and defining a system is important. So what I know is my oil system, for example, has a back test over 6 years, and I've been trading this system now for 4 years. Total trades, 571 trades. We got winning trades 58% of the time. It's a winning trade. Average winning size 76 ticks. Average losing size 26 ticks. A largest winning trade 557 ticks. Largest losing trade 153 ticks. Max drawdown is 450 ticks. These numbers are very important. For example, winning size 76 ticks. If I'm over my winning size, my average winning size, I'm reducing my risk. I'm taking off size. Okay, so I'm off a third or off a half at that point. And, I'm using these numbers to inform me about managing risk, okay? Maximum consecutive losing trades, 5 in a row. If I lose 5 times in a row, my very next trade is going to be a big one. I'm going to really double or triple up my size because, according to my system, I know what happens next, okay? Or even if it's 3 trades, I also have a histogram showing maximum losing trades, like, what percent of the time would I lose after 3 trades, okay, that are losers. So, stats are very, very important, and you should definitely use them. And I think earlier I showed you this histogram of drawdowns, and whatever system you're trading, create a histogram of what's the frequency of my losers. So losing $200 on a trade is nothing, okay? But the way this helps you is you look at, 88% of the time my losses are under $1,000, okay? So if I know that and I set my stop to $1 in oil, 88% of the time I'm not going to hit my stop. So, this helps me look at stop size. It helps me manage the trade. So I guess that's the point, is for you to look at defining a system and trade professionally and look at, okay, how do I minimize my loss? How do I maximize my winners? Again, average winning size, average losing size, and this helps to inform you as to whatever combination of technical analysis techniques you put together. It helps inform you as to how you should manage your trade. So I hope this helps, and that's the ending of this portion of the webinar. and I have graphs and everything for it, and I'm not going to repeat myself because I don't want to go over it again, but basically, those things I just mentioned, you got to pay attention to them, and you got to define those for how you trade, and you got to use systems. Now, what I do is I use multiple systems, and when they all are lining up, then that's a great trade. So that's kind of how I want to answer your question. So anyway, so use stats and define your system. I mean, that's it. Okay. Next question, Jack.
Math is your friend.
Oh, absolutely. Math is your big time friend. Okay. In your oil example, you said that you would get back in on a pullback. Okay. At what point is your 1/3 out, 50% retrace based solely on the size of the pullback? Okay. So Ken, if I'm getting long in the example I gave, I take the previous swing, and when I'm 50% of the previous swing, I'm 1/3 off and my stop is at even. Okay. Then if it goes higher, great. And if I hit like a 100% fib trend line target area, I get out a second third. And then I wait to see what happens. And in this specific example I showed, I'm looking for a pullback. The pullback may come back 50%, okay? And then I'm looking to get back in, and I will maybe put on a third, maybe put on both thirds back, okay? So what I'm doing...
Do you want to throw me the screen? I'm just thinking,
Yeah, sure.
Might as well.
Fine. I don't know why my screen's not working, Jack. It's very odd. But that's my answer to your question. Next question, Jack. I think this is your question here about your signals. I've noticed that at various times during the day on the Twitter feed, you give buy and sell signals. Can you elaborate a little on those signals, as I am a newbie?
All right. The signals are just one tool. All of these things are just tools. We tend to use them in combination, but the signal is quite a good tool. And what they are is, you can see them on here. If you look at, there are thousands and thousands, many thousands of charts posted on my blog. They've all got, if you look at the RSI 5 and the RSI 14, sometimes the RSI 2, but usually I'm just using that to put, as a nice space I can put text in. So, but you'll notice these arrows, and these are the signals. And these are divergences. If you have a look at this one here, for instance, this is a current example. This is the RSI 5 buy signal on oil. This is WTIC, which is the CL RTH equivalent chart that I use. And here you've got a buy signal that has fixed here, and this is basically, here you can see you've got price lower, higher on RSI, and you've got higher and lower here. So they are reversed. That's your divergence. It's at an extreme. So you are basically, you're really, these levels here, you've got the 30 level, the 50 level, the 70 level, and loosely speaking, your 50 level is your middle, and you're at 70, you're starting to consider it as being overbought, and at 30, you're starting to consider it as being oversold. So really, you're only looking at your divergences when they have reached either the 30 or 70 level. Yeah, and you can go lower after you can see this first arrow here is the first signal. It goes lower and reconfirms on increased positive divergence. That happens a lot. So, and what I'm doing is I'm calling these signals, this is on the monthly chart, and I'm calling them on the 1 minute and 5 minute charts for intraday highs and lows, because actually the 1 minute and 5 minute charts, you see the same patterns pretty much. The falling wedge I was talking about, I think I was calling a very nice rising wedge yesterday on the 1 minute chart. I think that took 2 hours to form or 3 hours to form or something, and then break down, delivered beautifully. This one here, this one here has been forming for 12 years, and when we were at this low on oil in February in chart chat, I was talking about the possibility we would make a low in the 26 area at this trend line here. And if we did that, I was talking about the possibility that the next target within this wedge would be this trend line here, which was at 95 at the time and is now at about 93. And I have to say that sounded pretty crazy at the time, but we're on the way. And this looks like an IHS forming. That's an arrow of where that IHS would go, and at that point it doesn't look so crazy at all, does it? It's that's the power of trend lines and patterns, because you can see on the monthly chart the very long-term patterns. It's this triangle here delivered beautifully, false break up, and when this broke, I gave a target. It was either the target for the triangle was either going to be back at the retest of the 2008 high, or it was going to be in the 45 area.
Yep.
And it delivered. These things often deliver. Math really is your friend.
Yep.
All of these things are mathematical. And math is your friend in so many respects as a trader. You can do your stats with it. You can work out where reversal levels are with it. You can pick your entries with it. You can pick your exits with it. And you can manage your trades so that you can maximize your chances of coming out with a profit, regardless of whether your initial premise was right.
Next question. Stan and Jack, I'm currently trading spreads like iron condors on indices 3 to 4 weeks out. What do you think about using a twice-a-week chart service in conjunction with this method? Thank you. Well, David, it depends upon how you're using the service. Now, if you're using iron condors or risk reversals with options, okay, which is what I still trade, I still use both, I'm looking for prime setups that are going to have at least a 3 to 4 week trend. Okay, and so you got to be picky with your setups if you're doing something that far out. So I'm assuming by your question that you're looking for a result 3 to 4 weeks out, and you're using options maybe that are 2 months out. Okay, so you don't get hit by premium decay. Okay, maybe even 3 months out, so you're not getting hit by premium decay. So you know, I think it depends upon. Well, you have to choose the setup wisely. Okay, so a lot of our traders are short-term traders. So like Jack's daily update and the morning video is about short-term trading. It's like the next day or two. Okay, the daily update is about the week basically. Okay, but if I'm trading 3 to 4 weeks out, I'm looking for a significant setup on a 4-hour or a daily chart. Okay, that's what I'm looking for. And the updates twice a week, well, guess what? That's just telling me how the setup is going. When the setup has failed, well, then I get out of my trade. Or, you know, if I'm losing 50% of my option, if I'm at a 50% loss in my option, the chance of me getting my money back is almost zero. So, you know, you take that big of a hit on an options trade, you get out of it, and you say, next trade, because that's all there is. Okay, yeah. So that's my advice about that. Now, if you're the worst case scenario is if you're a day trader and you only get updates twice a week, well, that's a problem. Okay, because the updates don't match your trading time frame. Anything you want to add to that, Jack?
Well, what I would say is this is actually one of the rare services where we do actually provide timings as well. I don't provide those, Stan does in the cycle windows. But if you've been reading my blog, I've been talking about the high window we're in at the moment. We have high windows, we have low windows, and they work pretty well.
Yep, absolutely.
So if you're doing options, I have to say, in terms of actually trading options, I've got almost nothing to say, so I've never traded them. I have no plans to even know, and I've done almost zero research on them. But the thing is, if what you're looking for is setups and timings, yeah.
I think the setups and timings are key for options trading, and I still use options, but the reason I am more a futures trader than an options trader is futures are 24/7. I can get in and out. I can do whatever I want. I'm not locked out of the market, and I absolutely love it. I really do, because trading has really changed in the last 5 years for sure, as far as I'm concerned. Which index do you use for analyzing futures? The generic, he has CL1 here, or the actual one? The analysis could change a lot. What I use is I use what I trade. Okay, that's my bias. Now I trade ES, but I use the S&Ps. I use both because, you know, it's always good to see what cash is doing. Okay, so, you know, for oil, you can use WTI, and you can look at both, and there's nothing wrong with that. For DX, you can use, you know, DX the future, or you can use DXY, which is my trading symbol for DX. So, you know, having both is useful because you can look at both and look at, you know, how they're different, how they're similar. It gives, and what happened in the evening in futures, and how will that affect cash and all that. So, you know, anyway, that's my answer to your question.
Yep, I would add to that. I'm generally looking around for an RTH proxy as close as possible to model the future. And the reason I'm looking around for that is on the longer term charts, the roll plays absolute havoc with trend lines. To the extent that it really makes trend lines pretty much impossible. High quality trend lines don't really exist with a roll. So if I'm using, if I'm trading ZB or ZN, then I will be looking very carefully at the TYX and TNX charts, which are very good, inverted, but very good. You know,
equivalents
Yep.
that actually strip out the effect of the roll. And there it's a that's probably one of the best examples. It's inverted, but it's a beautiful example. You use those a lot, and you can get wonderful long-term trend lines out of both of those. And if you're looking at the longer-term trend lines on bonds, for instance, then that's what you need to do. If you're using if you're on all futures have different ones. I mean, WTIC, this is the oil equivalent of that.
Yep.
Again, it provides very good trend lines. You can see this wedge has been forming for 15 years, and it bounced exactly as support. You cannot get that on the oil continuous futures chart. You won't even get within a country or three of that. You can get it. You can get it on this if you find the right instruments. If you're looking at live cattle or coffee. Let's have a quick look. That's I've got
the other option that you have, and just let me say this, because trading futures, you can get a feed, and you can adjust the feed in terms of equalizing closes and that sort of thing to take out the roll. Okay, and so you can do that. And a lot of guys, what they do is they just trade futures with RTH charts, and they take out the Globex, and you get the same trend lines. Okay, so there are other ways of doing it with futures as well, and I think it's worthwhile learning how to do that with a futures chart and still have the cash equivalent. Having both is very important.
Well worth it, and you do get very good results out of it. But this is, for instance, you find there are a number of very useful little indices that you can chart with. This is the Bloomberg Sugar Subindex, and this is a brilliant RTH equivalent for the sugar future. And you can see here it's delivering wonderful trend lines. And here we've got this hit up here, and then we had exactly the trend line here, and then we've got another one today. I shorted that. That's a very nice trend line hit. Chances are it's going to hold and it's going to fold.
Yep.
And that is, these are available for most of the futures. I use similar ones on coffee, live cattle. Again, live cattle, brilliant example. That's making a very nice looking low at the moment. Mm-hmm. Okay, but I mean, probably haven't got time to show that.
Okay. Can you confirm the ATR on the E-mini? I thought I heard 7 ticks and then 7 handles. So Larry, apologize. I may have gotten my wires crossed in my head about oil versus ES, but the E-mini right now, I believe, is 21 handles is the current 5-day ATR. Okay, so if it's 21 handles, 1/3 of that is 7 handles. So I'm using a 7-handle stop on the E-mini right now for a swing trade. Now, what I'm doing is I'm waiting for a proper setup. And last night what I said is look at the possible divergence here on a new high. So if we see a new high with a divergence, there's my setup, and my entry is going to have a 7-handle stop if at that moment in time, of course, ATR is still 7 handles. Okay, do you trade options? How do you deal with time decay? Okay, Mike, how can I say this?
I think you actually covered that to an extent already, but I think it's worth repeating quickly about the trading, 3 months out. So.
I think there are 2 ways to deal with time decay. First of all, you can sell puts in a bullish market, for example. That way you're harvesting time decay, and time decay is on your side. So there are ways of trading options where you can harvest time decay. So if you're new to trading options, my thing is, I'd be selling puts when you're at a very, very near-term ending to an options period, like within a 3 to 4 week ending of an options period when time decay really hits hard. You can trade options and you can harvest time decay. That's something you can do. So, and now if I'm trading options and I'm trading spreads, now what I'm doing is I'm looking out 3 months. So if I'm trading today options, I'm looking out into probably at least the November timeframe, maybe even December, for something I'm going to hold for a couple of weeks. Why? Because, that first month, if you will, the time decay is going to be minimal, and it accelerates, of course, as you get closer and closer to your expiration. So that's kind of how I think about it, Sebastian, for what it's worth. Okay, and guys, you're welcome. We got a bunch of thank yous, good summary. How did you two meet? So there's a question, Jack, that
there is.
That you can answer if you want. I think we met, first of all, in a trading room, and I won't mention which one it is. And I think we respected each other's work. And then we got involved in Princeton Trader, and in Princeton Trader, Jack and I started collaborating with one another, and we really, our work really complements each other in a high degree. So those of you who are subscribers, I think you see that, and we started this service in July of last year, and we've been going great guns ever since, and I think we both love it. I mean, I enjoy it.
Yeah, because I mean, we started basically having a meeting once or twice a week to compare charts and trying to work out where the best opportunities were. Because where we had crossovers where I was seeing a big opportunity and Stan was seeing the same opportunity from our different perspectives, we generally had a very, very high hit rate. And so we started doing that, and then people asked if we could possibly do this with them as while they were watching. So we started doing the webinars, and it sort of grew from there. But yeah, that was how the chart chats got started.
Yep.
And everything sort of built up from there.
Yep, and as long as I'm having fun at it, I'm going to keep doing it. And
yeah, me too.
I think that's all the questions, Jack, and I think that's a wrap.
I think it is.
All right. Guys, what I'm going to do is I'm going to take those screens, and I'm just going to somehow take a picture of them and superimpose them on that explanation I gave. So for those of you who didn't see the screen, I'll figure out how to do that.
Some of those were on the video, were showing. Basically, some of those were shown. We just basically lost it about halfway through. You were talking about that, I think. You won't have to replace all of that. Some of it will be on it.
All right, very good. Anyway, pleasure as always, Jack. I'll see you. Take care. All right, bye-bye.